Yo, it's Midas. Let's talk about how to think like a 10x investor. This is a preview to the Midas Strategy, the asymmetric investing framework for 10x returns. So disclaimer, everything said in this video is only for educational purposes. Make sure to always do your own research. But this is why you should listen to me. Midas will I beat the S&P 500 by 103x in less than a year. If you want the proof, you can check it out my link in bio. But let's get to the first slide as to how to think like a 10x investor. Well, you know, this whole strategy is off of the Midas strategy, where I'm able to find all these early winners, like, Oklo, QBTS, Spaghetti, stocks in the nuclear or quantum niche that ran up over 1,000% in the year or so, or just any other speculative technology like AI companies like Black Sky Technology, Big Bear AI, Nebius Group, to name a few. And the whole reason of this whole 10x investor thing is to stop chasing hype. Like when a stock runs up 100 or 200% in a week, you know when to avoid that because you would have positioned yourself to be in the stock or in that play before it even runs up 100% or 200%. That's the whole goal of being a 10x investor is to catch these early opportunities as soon as possible. And that starts with creating conviction. So I'm gonna mention this a lot of my posts or a lot of like in this video, but when you're investing in the stock, you should do thorough research as to why that company could 10x or why that company is going to do well in the future. Because that conviction and that research that you did puts you in the mindset that even if the stock goes down 30 to 50% because of bad earnings or just, bad macroeconomic environments like tariffs, you won't panic sell because you understand what the company does and why you're actually bullish on it. So let's talk about why you miss these explosive stocks. Well, you find winners after they run 100% or more. You probably are wondering, maybe you're like scrolling through, like, damn, how did Nvidia go up 100%? Or how did Tesla already go up 200% in the last year? How did I catch that? Well, people like me and people like other 10x investors have already positioned themselves to understand where the catalysts were, why the company was going to go up in the next few years, and they positioned themselves to capture that 200% swing of these big technology companies. And this is probably you right now. You probably follow hype blindly, you buy high, and then you become exit liquidity. To name a few companies that people might have, FOMOed into these companies that have ran up like 200% in like a day is like Beyond Meat, Buru, Open Door, all these companies people have just invested in thinking that it's a meme stock, it's a get rich quick scheme. They put in lots of money, and because it runs 100%, they're like, I'm going to capture this momentum, I'm going to capture the swing, and I'm going to get out before everyone else does. But little do they know, but when they get in, you're basically exit liquidity because people like myself have gone in before it runs 100%, so they're taking profits on the way up. And that's what a lot of retail doesn't understand. That's why retail traders get burned. So this is the truth about being late, about the stock that you see on social media, or you see them in like the 24 hours, the most volume stocks that just have run at 100% in a day. But by the time you see those stocks, whether it's influencers like myself or people are calling it online, it's probably too late. And I mentioned this a lot in like the Beyond Meat craze, where a lot of investors were trying to get in. They're like, "Am I too late? It already ran to $2," and they were thinking like, maybe I should get in. And they did. Sure, they did. So they got in at $2, it ran to $7. And when it reached $7, they were like, holy shit, it's going to hit $10. But that is where these market manipulators, these whales, that's how they get you. Okay? Because they probably bought in when it was a few cents, right? So they bought in early, they captured the swing at $2, and now they're selling again at $7. So that's why Beyond Meat crashed down to $4. So that's the issue. You would never sold because you got in so early, you're thinking that's going to go much higher, but it never does. Or even if it does, you'll never sell when it goes higher Beyond me could have went to past $10 and you probably wouldn't have sold because you are, well, at hurt, a gambler. You don't know how to manage risk and you're basically late to the party. So smart money, like myself, got in when no one cared. For example, Big Bear AI. When earnings happened, so it rallied off of, defense contracts, went from $3 to like $9, and then earnings came along. Earnings was horrendous. It was horrible. The stock crashed down to $3 and people panic sold because they bought it at $7 and they thought that would never recover. Well, next earnings came along. It rallied to $6, crashed again, and back to $3 it was. During these peaks, I still held onto the stock because I understood the catalyst of Big Bear AI. Now, the third earnings came along and it crashed, but it didn't crash as much as the last two earnings. And then finally, Big Bear AI just had its fourth earnings call. People thought that, they would just outsmart the markets and think that Big Bear AI would also crash again based off of bad earnings, but it didn't. It actually beat earnings or didn't beat as, or didn't lag behind for earnings, right? So because of that, the stock is now $7 from my call $3. That is what I mean by conviction. This is what I mean by understanding what you're buying into and holding it. Because at least it's better to be early into a stock that you like and having conviction to hold through these downturns than being late and ended up being exit liquidity for those that have got in very early. So this leads me to the Midas strategy framework of these asymmetric investing, where you have limited loss and unlimited potential in the graph below. But the whole strategy of this framework is to buy early by researching a lot into these companies to understand what they do, what are the future catalysts, how are they disrupting the world. That is how I pick my companies and how I pick them very early. And then after that, because they are speculative positions, they're bound to have downturns. While there's macroeconomic conditions, these companies will crash a lot quicker. Like think of Oklo. Back in the chairs, you could have bought that for like $10, $20. And yeah, if you got in and just held it, you could have held it to $170. That's almost a 17x from $10. So that's what the whole point of this strategy is to let time compound. You are better than a trader, better than a day trader because you have time in your hands. With my strategy, you are likely a long-term investor, or at least you are a swing trader. So you have time on your hands, time to hold out through these downturns, and to ensure that you are able to understand that while the market goes down, it will also rebound up, especially with these speculative plays when the narrative comes back in. So when you're investing, always think of this equation. Research, research the hell of these companies early, especially when they're penny stocks. Then you have the patience to hold on to these stocks during downturns because you understand that with new contracts leading in, with more people understanding the company and what it does, then that becomes an asymmetric reward. So the limited loss, whether it goes down like 30%, you can have the unlimited potential of it going 500% or more. Oklo, Rigetti, QBTS are big examples of this. Prime examples like QBTS and these quantum companies, they all crashed when Jensen Huang said that, quantum stocks are not here yet. A lot of these stocks crashed down like 200% in like a day or a couple of days. And now look at them now. They're now way past $30 from $3 when it crashed to. That's a 10x. These are companies that happen all the time, and I've seen it played out. I've seen it happen. So I'm telling you guys that this is possible. This asymmetric investing is possible, and that's why I'm telling you guys as a 10x investor, this is how I think. So another idea is to be early. It's better to be early, but not late. So it's better to be like, I called it first, than say I called it late. And calling it early could mean that you're down a couple hundred, a couple $1,000. And even the best investors cannot time the market perfectly. I'm telling you myself, I probably have a lot of bad entries as well, but I hold on to those entries because I understand that the upside is a lot higher than the possible downside. And think of it this way, right? Who could have predicted that tariffs would crash the market so much? And people that, say that, oh, they timed it all, or they said that the tariffs were just the perfect buying opportunity, I guarantee some of them definitely panicked at that moment. And even if they didn't panic, they probably panic sold. and they thought that the market would be going to a recession. Well, a couple months later, after tariff deals got lined up, and now, Trump resolved everything, now we're back to all-time highs with the market. So these situations can happen at any point in any investor's journey. Never try to time the markets. You could be down a couple hundred, a couple $1,000s. Just hold on to it. Don't panic sell. Trust your research. Trust your conviction. And buying in late, sure, it's not a big issue, but the main issue is that let's say you got into, Beyond Meat, right? You probably would never would have sold at the top. Same with many of these other companies. People are greedy. It's much better to say that you got in early to Big Bear AI, where it's at $3, then it crashed at $2 because of bad earnings, and then it flew to $9, compared to saying that you bought at $5, then it went to $9. The upside's a lot slower compared to you just bought in early. And the edge of this 10x investor mindset is preparation, not prediction. Like I mentioned, it's impossible to predict the markets. Markets can go sideways, they can go higher, they can crash down. It's impossible to tell. And despite what anyone tells you, maybe you can use the VIX indicators and all these different trading indicators in order to predict the markets, but it's a lot harder because if it was so easy, even the best traders like Michael Burry would have shorted the housing crash, a lot later on, so that he would be in profits. But he was down millions before he received his billions. But let's talk about the next concept, which is a long-term asymmetric investor. This is my sort of like time holding period for all these stocks I hold on to. I have a 3 to 6 month horizon or longer. So narratives, that's how I invest. I invest based off of narratives. I invest based off a basket of stocks I believe will run all together. And these narratives and these trends need time to mature. So my whole strategy is not to time candles, not to base off of these short-term noise, but to try to time narratives. That's what I'm waiting for. I'm waiting for narratives to pop up, for retail to come in, because I believe that all those stocks will run up as a whole. Another concept is I believe that day trading fails, and that's why I'm a 10x investor and not a 10x trader. So you can take a look at the right side. This is a lot of people just want to start trading tomorrow and get rich quick. Day trading is sold as this get rich quick scheme. I think it's a poison to the financial industry. But yeah, day trading sucks because you have no control and no time. So that means you have no conviction. So you're betting that a stock will run up past the strike price of $20, currently $10 in like a 2 week period. If that crashes or it goes to like $18, you lose all your money. At least with stocks, you can trim your positions. If it goes down, you can buy more, or you can just hold on to it until it breaks even. And also, you're playing against algorithms. Do you not understand that these hedge funds or these market makers are not doing the same thing as you guys? With a hell of like a educational background, to become a quant, you need a heavy math background, and you need to have a pretty high GPA. If you can't compete with that, how do you think most retail is competing with that? Why do you think most retail traders are down money and they're not actually beating the markets? And I believe that real wealth needs breathing room. If you're going to be playing these 10% scalping plays or 20%, like sure it might work. Maybe you might add up money slowly but surely, but eventually humans are emotional. You're eventually going to go all in one play and just basically lose it all because you were so confident you felt like a god by getting 80% gains with like 4 plays, but you just lost all your profit with one play. That's how J trading gets you. Another concept to worry about is focus on technology disruption, especially in this day and age. Technology is everything. AI is going to take over the world. Like take a look at Nvidia, Tesla. Look at these companies. Nvidia, you could have bought in 2019 when they were just making GPUs. But if you knew that those GPUs were needed for AI, you would have bet a lot in Nvidia. And with Tesla, we knew that Tesla was no longer a car company. When it crashed at $160 back in like last year, 2024, that was an insane buying opportunity. I bought tons of Tesla shares because think about it. How could Tesla fail? They have robo taxis, they have AI now, they have all the data of their EVs, they have an EV business, they have robotics, they have so many different avenues as they can win. Just because the car sales are going down in the short term, that does not mean that the company will fail in the long term. And if you know me, you would know that I bet on long-term companies. So look for these companies that change how the world works, like Nvidia and Tesla. Remember, I always bet on the future. I don't care about the present profit, about earnings and all that. Sure, it's good for like short-term pumps and for swings, but if you're betting on a company long term, you're going to be betting on the long-term potential of what it could do, what are the catalysts of that company. Another theory is to think like a venture capitalist, not a retail trader. All these retail guys are thinking about like earnings or like, oh my God, what is the PE ratio of this company? And I guarantee if you thought about PE ratio, you probably would have messed up on Palantir's run up like over 600%. So think like a VC, think like Pure Thiel and these guys who, bet millions into companies. They don't bet on like earnings calls. No, they bet on the company's value as a whole. What can it produce in the next 5 years? Another concept I think about as a 10x investor is if it can't 10x, it is not a Midas play. So I skip safe plays altogether. Maybe Nvidia and Tesla back when they were, you know, still undervalued. Now they're in the trillions of market cap now. Or like, any of the Mag 7 companies, I don't invest in them anymore because in order to achieve financial freedom, you need a lot of risk. And you can only get risk through asymmetric investing or through penny stocks. And both of them have a lot of risk, much more risk than any Mag 7 or any ETF out there. So I go where volatility meets conviction. I have a lot of conviction in all my plays. I believe they'll do well in the next 5 years. And the volatility will always be there. But if you never could not stomach the volatility, you probably never would have bought in or held on to Nvidia or Palantir to its very peak. And remember that one 10x winner can cover nine losses. That's why I always talk to you guys about, diversify, never full port into one company. Because many companies can do well, and if your company does not do well, you're either going to panic sell or you get very stressed out saying that your company is not going to do well. So always diversify. And I do believe that volatility is a price of greatness. This is happening right now, like a lot of stocks right now. Maybe like SUIG is a great example of this. Currently down like 40% from I call it $40 or $4. And despite that, I'm still bullish on the company. The fundamentals, the earnings have done pretty well lately. It's only down because of SUI. It's tied to SUI. We're waiting for altcoin season to come. And yeah, I don't see them diluting their shares. I don't see them like firing anyone for their executive team. So I'm still bullish on the company as a whole. And remember, down 80% is not equal to dead if your research is solid. People thought that Palantir was a dead company back when it fell down to $20, but I'm sure a lot of them are now kicking themselves in the corner from thinking that Palantir was dead. And conviction means holding even when it's painful. Scared money does not make money. This is a common idea in everything. You need to stomach those volatility if you want 10x gains. And remember, you only lose when you sell. If you sell for loss, you lost money. But you held into the company despite the downturns, you would have been in profit. Another idea is to not chase pumps. So this is a FOMO trader's experience. They buy into this greed and excitement, always happen, always FOMO in. Then they sell when fear and anxiety comes in because they didn't do the proper research. They just bought in just because someone told them to. And then they become impatient. The stock rallies again. They buy in it again. And the whole cycle continues and continues. This is why you don't chase pumps. So if it's already up 100%, just move on. I even told you guys about this with Beyond Meat. Like, think about it. If you bought into Beyond Meat after $2, you probably would never have sold it $7. And maybe if you did, you got lucky. But human emotions are extremely volatile. A lot of guys held on to the company because they thought it would go to $10 and never did. And now they're bag holding onto a dying company. And late entries are basically exit liquidity for early holders like myself. I'm always taking profits on the way up. I never try to buy the tops. And there's always another setup, always ways to make money in the stock markets. Don't get married because just one company's up 100% does not mean the company that you research will not do the same in the next few weeks or the next few months. And this is why this 10x investing mindset wins, because conviction is a lot better than timing. It's impossible to time the market. Timing for the perfect entry is not going to work on the long term. You might time it once, you might even time it worse in the future. So keep that in mind. And research is always better than emotion. Research helps you make your emotions tied up because if you understand what the company actually does, you're a lot more confident as to holding on to it when, you know, push comes to shove and the markets go down. And patience creates asymmetry. Big example of this was Palantir, Nvidia, or Tesla. Finally, just act like me. If you're scared of, investing, start applying asymmetric investing to your own thought process so you can find the next 10x plays before Wall Street does. But yeah, you got any questions about this video, comment them below and I'll respond when I can. If you want more alpha, join my free Discord, link in bio. If you want to take a look at all my stock picks, check it out, my link in bio. And yeah, subscribe and link for more. That's all I got for today. I'll catch you guys in the next video. Peace.